You're told it's fair, open, equal, and everything you see seems to confirm it. Charts, data, live prices. Anyone can participate. But here's what nobody says out loud. Some players aren't just in the game. They're seeing it before it starts. And once you notice that, everything feels different. Right now, you think you're watching the game. But by the end of this, you might realize you've been inside it the whole time. So if you want to see how deep this goes, subscribe, because this is where it gets uncomfortable. The system doesn't hide in darkness. It hides in plain sight. That's what makes it believable. Markets are open. Data is public. Participation is easy. Anyone can enter. That's why it feels fair. Because you're allowed to play. That's the illusion. But access isn't advantage, and information isn't understanding. That gap is where everything shifts. You see a headline, but someone else saw the conditions behind it days earlier. You react to a chart, but someone else was already positioned before it appeared. You read the outcome. They were already positioned. And by the time it reaches you, it's already moving past you. This is where the illusion cracks. Because the system doesn't deny you information. It just delays your ability to use it. A company releases earnings. A central bank announces a decision. A government signals a policy shift. By the time it becomes public, the largest moves are already underway. Not always visible, but already in motion. That creates the gap between those who act and those who react. Most people never see this gap. From the outside, everything looks synchronized. Charts update instantly. News spreads globally. It feels like everyone is moving at the same speed. But they're not. Some are playing in real time. Others are playing in hindsight. And the system never tells you which one you're in. Once markets start moving aggressively, those tiny delays become massive disadvantages. By the time most people realize it, they're no longer in the game. They're absorbing the outcome. That's when the illusion breaks. But by then, it's already too late to matter. And this is where the next layer reveals itself. If the system feels fair on the surface, what's happening underneath? There's a term for this: information asymmetry. It sounds technical, but the idea is simple. Some people know more, but more importantly, they know earlier. And that changes everything. Markets don't move on information. They move on who has it first. That's the real game. Not data, not headlines, just timing. Once you start looking for it, you begin to see patterns. Subtle at first, then impossible to ignore. Some people consistently act before major shifts, before policy changes, before market reversals, before crises become visible. It's not coincidence, it's position. Think about how decisions are made. Central banks don't decide interest rates in public. They meet behind closed doors. They debate. They model scenarios. Only after all of that, they release a statement. By the time you read it, it's already old information. Corporate decisions follow the same pattern. Mergers, buybacks, strategic pivots, discussed privately, executed quietly, then announced publicly. But the positioning happens before the announcement. Always. Because it has to. Sometimes, the gap becomes visible. In 2012, a confidential Federal Reserve policy signal appeared to leak, not publicly, but through a private channel, a newsletter. distributed to a select group of clients. It described the Fed's upcoming decision before the official release. Almost perfectly. A 24-hour advantage. That's all it took. 24 hours doesn't sound like much until you realize, in financial markets, that's an eternity. That's positioning time. That's profit. That's the difference between reacting and controlling the outcome. It wasn't the first time a 24-hour gap changed everything. In June 1815, Nathan Rothschild received word that Wellington had defeated Napoleon at Waterloo, a full day before the official messenger reached London. While the public watched government signals, Rothschild relied on private networks, messengers, routes, eyes near the front. He moved on the bond market before anyone else knew the war was over. The tools change. Pigeons become algorithms. Couriers become fiber optic cables. But the structure stays the same. One day's advantage. That's all it takes. It's not an isolated pattern. In early 2020, before global markets collapsed, certain policymakers received private briefings. The public message remained calm. But behind the scenes, actions told a different story. Stock positions were reduced. Risk was quietly removed. Weeks later, the market caught up. The time most people understood what was happening, the exits were already crowded, because some people had already left. That's the pattern. Quiet, consistent, and it extends beyond policy, into institutions, banks, funds, corporations. Before the 2008 financial crisis, certain firms began reducing exposure to toxic assets. Quietly, gradually, position by position, while others continued buying, trusting the system, until the system broke. And when it did, the damage wasn't evenly distributed. It never is. The people closest to the system don't just see risk earlier, they move earlier. That's the advantage. This is where it becomes undeniable. In September 2008, as Lehman Brothers collapsed, SEC filings revealed that certain institutions had already reduced their exposure in the months before the crisis became public. While retail investors were still buying the dip, the exits were already in use. The system isn't failing in these moments. It's behaving exactly as it was built to behave. Every complex system creates layers, decision makers, information pipelines, and delay. And those layers create separation between those inside and those outside. The further you are from the center, the later you see the truth. That's not a glitch. It's the structure. And once you see that structure, a bigger question starts forming. If this pattern keeps repeating across different countries, different eras, different crises, then maybe it's not accidental. Maybe it's historical. Maybe it's structural. And maybe it was never meant to be fair in the first place. This isn't just happening now. It's been happening for a very long time. This pattern doesn't begin with hedge funds, or algorithms, or central banks. It begins with the nature of information itself. As far back as the 2nd century BCE, Greek Stoics described the advantage of privileged information, a grain merchant who knew a famine was ending before anyone else. He arrived with supply before the news did. That gap was his profit. In 1815, Nathan Rothschild built a private courier network. Ships, relay horses, carrier pigeons, delivering news of Waterloo 24 hours before the British government. He didn't break the rules. He built a faster network. Faster meant first, and first meant everything. By 1933, the US passed the Securities Act because information imbalances had tilted markets against ordinary investors. They tried to close the gap. The gap adjusted and continued. Different centuries, different instruments, same structure. The system was never designed around fairness. It was designed around information flow. Information has always moved faster for some than others. That's not a modern problem. It's the oldest problem in markets, and it was never solved. It was just renamed. So the pattern is clear. It repeats across crises, across decades, across completely different systems. At some point, a bigger question starts to surface. Why does this keep happening? Why does every system, no matter how modern, regulated, or transparent, create the same imbalance? The answer is less dramatic than most people expect. Nothing here is broken. This is how systems naturally evolve. Every functioning system needs structure. Without it, nothing moves. But the moment structure appears, so does hierarchy. And with hierarchy comes information flow. Not evenly distributed, layered, controlled, sequenced. At the center of every system, there are decision makers, necessary, central bankers, corporate executives, regulators, legislators. But here's the part that quietly changes everything. They cannot make decisions in public because decisions require discussion, uncertainty, debate, private analysis. So before anything becomes official, it exists privately for hours, days, sometimes longer. A central banker hears projections before the public sees inflation data. A CEO knows earnings results before investors read them. A government debates policy outcomes long before headlines announce them. In that gap, something subtle happens. Positioning, not always visible, but unavoidable. Because once information exists, it can't be unseen. This is the first layer, decision makers. The second, information pipelines. Because information doesn't move randomly. It flows through channels, some faster than others, some deeper than others. Corporations generate internal forecasts before public filings. Banks run models before markets react. Funds analyze signals long before they appear on charts. In the modern system, machines have entered the game. Algorithms scanning news in milliseconds, parsing language, detecting tone shifts, positioning instantly, before a human even finishes reading the headline. And then, there's something even harder to see. Signal interpretation. Because not all information is explicit. Some of it is implied. The wording of a statement, the hesitation in a press conference, the subtle shift in guidance. And certain players don't just read information, they read intent. On the outside of the system, the public waits for confirmation, for clarity, for official release. And that delay is the third layer, delayed awareness. Announcements are scheduled, released at fixed times, processed by media, distributed across platforms. By the time it reaches everyone, it feels immediate. But it isn't. It's already late. Because the system is designed to release information, not reveal it in real time. And when you combine all three layers, something inevitable happens. Insiders act. The public reacts. Every time. A central bank signals tightening internally. Positions adjust quietly. Then the announcement drops. Markets move sharply. But the foundation of that move was already laid. A corporation anticipates weak earnings. Executives adjust. Funds reposition. Then the report is released. And suddenly, it looks like the market reacted. But it didn't start there. It ended there. This is why markets often feel confusing, why moves feel sudden, why outcomes feel unpredictable. Because what you're seeing is the final stage, not the beginning. And this leads to one of the most important lines in the entire system. By the time something becomes public, it's already priced in. That phrase gets repeated often, but rarely understood. It doesn't mean markets are efficient. It means they're layered. And if you're seeing the information at the final layer, you're not early. You're on time, which in this system is already late. And yet, for long periods, this imbalance doesn't break the system. It continues, quietly, functionally, because most people still believe the game is fair. And as long as that belief holds, the system holds. But belief is fragile. And once it starts to crack, everything changes. Systems don't fail the moment they become unfair. They don't fail when insiders gain advantage. That part can continue for years, even decades. What breaks a system is something much simpler: recognition. The moment enough people see the gap, not suspect it, not feel it, see it clearly, that's when stability begins to erode. Because every financial system, at its core, it runs on trust, not money, not data, trust. And the moment that belief weakens, the system doesn't bend, it accelerates. Take a bank. On paper, it may be stable. Assets in place, loans performing, balance sheets intact. Banks don't hold all deposits at once. They can't. They rely on the assumption that not everyone will withdraw at the same time. And most of the time, that assumption holds until it doesn't. Because all it takes is doubt, a rumor, a signal, something that suggests the system isn't as stable as it appears. And then, everything moves at once. Withdrawals begin. Others notice. They follow. Not because they understand the system, but because they understand risk. And suddenly, a stable system becomes unstable. Not because it changed, but because perception did. The same principle applies everywhere. Markets, currencies, entire economies. They don't collapse at the first sign of imbalance. They collapse when the imbalance becomes obvious. When people realize they were reacting to a system others were already navigating ahead of them. That realization spreads fast, faster than policy, faster than response. And once it reaches a critical mass, there's no gradual decline, only acceleration. Because trust doesn't fade slowly. It breaks suddenly. And in that moment, the system reveals what it always was, not broken, not malfunctioning, just exposed. We return to the beginning, the idea of a game. A system where everyone appears to play by the same rules, but some players see more, move earlier, act faster. And for a long time, that difference stays hidden, because the system continues to function. The illusion holds, until the moment it doesn't, until enough people realize they were never seeing the full board. And that's when everything shifts. Because the system doesn't collapse when it's broken. It collapses when people realize it was never fair. And that leaves one final question. Not whether the system is fair, because it isn't. It was never meant to be. The real question is simpler. Do you understand the rules before they do? The system doesn't warn you before it shifts. It just moves and expects you to catch up. If this made you see things differently, like this, it tells us to go deeper. Subscribe, because the next part breaks down what happens right before everything collapses. And share this with someone who still thinks the system is neutral. Because once you see the pattern, you can't unsee it.